welcome to the Tax Roundup for October, and it's been a month of surprises this month. First up, we're looking at the housing affordability measures that were announced in the budget, looking at the exposure draft release for that additional CGT discount for investors in affordable rental property. We'll also look at the clarity that's been released on the rental property deductions as well. But importantly to those accountants that are dealing with self-managed super funds is the release of the transfer balance account report for self-managed super fund event-based reporting. And doesn't that look like fun? Now Ray is going to take you through what that means and what's actually on the form and what you need to be looking at now. But in the biggest surprise of the month was the exposure book draft from Treasury, which seeks to make retrospective changes to the company tax rate to limit the number of people who can access the reduced company tax rate. Across to you, Mike.
Now this month we've finally made some progress, or it looks like we might be making some progress in terms of really settling down when can a company qualify for the lower tax rate. Unfortunately, we're still not quite there yet, and in some ways the announcement that was made by Treasury, or the new draft rules that were released by Treasury this month, actually open up a few more questions than what we had before. Let's just take a step backwards. We know that government has put in place some changes to lower the corporate tax rate for certain companies, moving to a point where all companies will qualify for this lower rate at some point in the future, maybe, depending on what happens. The problem that we've had, I guess, over the last year or so is that there's been a bit of uncertainty in terms of when a company's actually carrying on a business. And part of that comes from the ATO's comments in a draft tax ruling that was released earlier this year. Now, we've been waiting quite some time for the ATO to finalise that ruling, or at the very least issue some other comments clarifying exactly when they consider a company to be carrying on a business, because there have been some comments made that suggest that the threshold for a company is lower than it would be for maybe other taxpayers. So that's where a lot of this confusion has come from. That then led to questions about, well, maybe more companies can qualify for the lower tax rate than what we first thought. So it opened up the possibility maybe that companies that derive what we consider to be passive income might still qualify on the basis that they're still carrying on a business, that it's a lower threshold, carrying on a business to make a profit. They can therefore potentially qualify for the lower tax rate. Now, while we were waiting for the ATO to clarify that, and we still are, the government came out and said, well, hang on, these rules aren't meant to apply to passive companies. That was a little while back. We've now got draft legislation that's trying to basically lock that position in. Now, basically what the draft legislation says is that for the 2017 year onwards, now remember the 2017 year's finished, and some companies would have already lodged their tax returns, and some of the shareholders who received dividends from those companies would have lodged their tax returns, and trusts that received dividends and then paid that on to beneficiaries might have all lodged their tax returns. You've got to go back and now revisit the rules, potentially if these rules actually go through. What the new rules say is that to get the lower corporate tax rate in the 2017 year onwards, you need to be a company that carries on a business. Your aggregated turnover needs to be below the relevant threshold. So for 2017, it's a $10 million threshold, going to $25 million in the 2018 year. But there's an extra conditions that needs to be met. That extra condition is that your passive income mustn't be more than 80% of your total income for the year. And passive income is defined in a very strict way. So passive income for these purposes would include dividends, rent, interest, and certain other things, including capital gains. And those things are passive, and you kind of compare that to your total income and see whether that 80% rule is passed. Now, a couple of tricks with that. One is that dividends, while they're normally treated as passive income under these rules, they're not if they're non-portfolio dividends. Non-portfolio dividend is simply where one company pays a dividend to another company, and the company that receives the dividend holds shares in the company paying the dividend that provide at least 10% of the voting power. So all of a sudden, dividend that was going to be passive is now active. It's kind of business income for the purpose of that 80% test. It doesn't seem to depend on whether the company that paid the dividend was carrying on a business or derived all of its income from passive activities. So you could have company one just earning rental income, pays tax presumably at 30%, pays a fully franked dividend to company two. If company two holds 10% or more of the shares of company one, then it may well qualify for the lower corporate tax rate, which might end up with a bit of a mismatch. You might end up with only a 27.5% franking when dividends go out to the final shareholders with franking credits trapped in that second company. So there's a few practical implications that flow on from that. Now, the other thing that looks to change, and again, remember this is from the 2017 year, is that the $10 million threshold will stay, but it will only look at 2017 year turnover. Now, as the law stands right now, a company that carries on a business in 2017 can qualify for the lower tax rate if its turnover is less than $10 million in either 2016 year or the 2017 year. So the government is proposing to change that and basically say it doesn't matter what happened in 16, we're only looking at 17. Now, there would be companies that thought they qualified for a lower corporate tax rate in 17 because of their prior year turnover, even though their current year turnover in 17 might have been above $10 million. Those companies are going to have to revisit this again, check whether they're actually subject to, what rate they're actually subject to. Not only that, they'll have to reassess franking rates. Some of these companies have already altered the franking rate on a retrospective basis. Given the slow passage of the original legislation through Parliament, they're going to have to go through that process again. Check what rate applies, what franking rate applies. They might have to inform shareholders. Shareholders might have to amend returns, and it goes on. There's potentially a fair bit of work for a whole lot of people to do if these changes actually go through. So there's a bit to take into account. Look, again, this is only draft legislation, so it may all change. We don't know where this is going to end up. But we really do need to flag it now that this is a bit of an issue. All those questions that are floating around company tax rate, particularly for 2017 year, it's not the end of the story yet. We've still got a little while to go to see exactly where this is going to end up, both in terms of what the government's going to do with this legislation, but also waiting for the ATO to clarify a little bit around still that definition, that concept of what is a business. So keep an eye out for further developments. This has still got a little bit left to run before we get to the final position, somewhere that we're a little bit more certain about. But it looks like things are happening, just possibly in a way that is a little bit different to what we thought it was going to.
Michael has a webinar coming up on the 2nd of November called the Small Business Company Tax Minefield that will take you through all those changes in the exposure draft, what you need to look at, who can access the reduced company tax rate. But now across to Ray Itaoui, who's going to take you through that transfer balance account report. Across to you, Ray.
The transfer balance account report, the TBAR, is now available online. It is a form you need to use to report events that impact on the transfer balance cap. From 1 July 2017, SMSFs need to report all events affecting the transfer balance cap. There has been an exemption provided where super funds don't need to start reporting on this until the 1st of July 2018, but we are strongly suggesting that people do start looking at this now, because even though you need to start reporting from 1 July 18, the events still need to be reported from the 1st of July 2017. So you need to be thinking about this now. The TBAR form came out yesterday, so it's available for us now to start reporting these events. A bit of a background on this form, it's not actually available online until January. So whether that means that people will be filling paper-based forms and sending them to the ATO, or waiting until January, we'll have to wait and see. But looking through the form is fairly logical to work through. It is a bit lengthy, but the major area of concern, I guess, is around the fact that each event needs to be reported individually. So that means that every time there is an event that affects the transfer balance cap, you need to submit an individual form. If you have a think about some practical examples that you might be working through, including the fact that you also need to report the opening balance of these pensions, the amount of reporting that you'll be required to do as a result of this TBAR form could really change your processes and your operations for your administration team. If we have a look at a simple example, where there's two members of a super fund, if we assume that they're self-employed, they're running their own business, they decide to sell their business and make a large contribution into their super fund, and they retire. They commence pensions on the amounts that they've transferred in, and then they subsequently take out lump sums in order to be able to buy a retirement home. This is a fairly common transaction that you might tend to see with some of your larger clients as they work towards retirement and selling off their business assets. Now, if you move across to the TBAR regime and then working through this report, what you'll find is that you'll need to probably report upwards of 5 events for this transaction. It could be 6, 7, 8 events, depends on how many lump sums they withdraw and how it's all structured. But if you think about the compliance involved with having to report on this event, it really could take up a lot of time. So we're hoping that the software providers do build something into the system so you can actually lodge this online without having to go through individually completing these forms every single time. But it's something that you just need to probably start thinking about now and planning ahead for. And really, on another interesting note, what we have seen with this form is that it's quite clear, they've made it quite easy to actually amend or cancel previous TBAR forms. Now, looking ahead and thinking about how this might work, it could be the case where people or accountants fall behind their reporting, potentially submit reports with the option of changing them later. And it's quite an area of concern. We're not sure what the ATO has in place around the regulations or requirements for changing these forms and cancelling these forms and submitting new ones. But it's really an area where you don't want to place any emphasis on being able to lodge these nil reports and then going back and amending them later. There might be a grace period initially, but we expect that the ATO would probably put something in place to limit the ability to do that. Otherwise, people might circumvent the entire nature of this reporting. The only thing we don't know at the moment is the frequency of the reporting. The ATO's consultation on this came to an end on 15 September. We'll let you know as soon as we hear something.
Now across to Michael, looking at the clarity on the rental property deductions and also the exposure draft on the additional CGT discount for investors.
Now, following on from government announcements earlier in the year in the federal budget, we're now seeing a bit more movement in terms of developments in relation to what the government says relates to housing affordability. So we've got a couple of different things on the go at the moment. One is the release of some draft legislation that relates to additional CGT discount that might be available to people who invest in affordable housing. The idea there is that for those people who invest in affordable housing as defined, either directly or in some cases through trust arrangements, their discount percentage can be increased potentially from 50% maximum up to a maximum 60%. Now the key thing is that the property needs to have been made available for affordable housing for at least 3 years over the ownership period. Now the way it works is that there may need to be some apportionment of that extra 10% discount percentage. And it will take into account the way the property's been used. So if it's only been used or made available for affordable housing for part of the period, then you'll get a bit of the extra 10%, but you won't get the whole lot. The other thing that needs to be factored in is that some individuals are subject to a discount which is somewhat less than 50%. And it might be because they have been a non-resident or a temporary resident for some of the ownership period. That will also impact on this extra 10%. So to the extent that someone's discount percentage has already been reduced, that will also flow through to this extra 10% component. So while there may well be some people who get a full extra 10%, there are a few hurdles to overcome before you get there. Anyway, that's draft legislation only at this stage. Again, there's probably a little bit more to go before we have final law in that area. Now, where we are getting closer to having some final legislation is around the travel deductions for rental properties and also depreciation deductions on certain assets used in residential rental properties. The legislation, the bill containing those changes has gone to Parliament. So again, we're getting much closer to final law. The changes are expected to take place for travel deductions from 1 July this year, 1 July 17. Likewise for depreciation deductions for the 2018 year onwards, so for the year beginning 1 July 17, for most people those changes are intended to take effect. Now for travel deductions, basically what the rules say is you as a rental property owner, as an investor, will no longer be able to deduct travel expenses to the extent it relates to deriving income from a residential rental property. Now there are some exceptions. Those people who might carry on a business of renting properties are exempt. They can still claim their deductions. And certain entities, so companies for example, can still claim deductions for their travel costs. But from 1 July 2017, the idea is that for most individuals who are not carrying on a rental property business, travel deductions won't be available to the extent they relate to their residential rental properties. Now the other thing that goes with that is that if you can't claim a deduction for those travel expenses, they're also excluded from cost base. So sometimes where we own a property and we can't claim a deduction for an expense relating to the property, we add it into the cost base to reduce capital gains in future. Under these rules, that isn't possible. You don't get the deduction, but you also don't get to add that cost to cost base of the property for CGT purposes. The second major change in that bill is around depreciation deductions, and this was one of those things that caused a bit of a stir around budget night, just in terms of, is this quite a significant change maybe that's happening in terms of rental property landscape. Now I've got to say the actual changes that look like they're going to come in, they will take a bit of time to get our heads around. They're pretty complex. The basic thrust, I guess, of the bill is that from 1 July 2017 onwards, so for the 2018 income year, residential rental property owners won't be able to claim depreciation deductions for assets that are being used by someone else in earning residential rental income. Also, you won't be able to claim depreciation deductions for items that you have previously used for a non-taxable purpose at some time in the past. But how we actually get to the final position under those rules is a bit complex, and it will take some time to identify clients who might be affected and then actually figure out which assets are caught by the new rules, because it won't be all assets. There might be some pre-existing assets that are still okay, some newer assets where you might have some problems in terms of claiming depreciation deductions, but also then working that through in terms of final calculations on sale of the property or sale of the assets. That aspect becomes much more complex as well. So there's quite a few things that will need to be factored in to clients who might be affected by these changes. Look, it's not going to be a straightforward change for a lot of people. Probably the good thing that does come out of this is that the government has, provided some concessions for people buying off-the-plan properties. So where you're buying an off-the-plan property, newly installed assets are sitting there on the property. They may have been used for some, non-rental purposes by the developer prior to selling the property. There are some carve-outs, so depreciation still can be claimed by the first real owner of the property who is using it as a rental property for the first time. But again, there are some strict conditions that need to be met to fall within the scope of that exclusion. So quite a bit of work to do where you do have clients owning rental properties, and probably well worth getting hold of the bill and the EM, having looked through some of those examples now to try and understand exactly who will and who won't be impacted by these changes.
And that's the tax roundup for this month. Don't forget, if you're not a member of Knowledge Shop and you'd like to see what's on offer with our Accountants Help Desk, Workpaper Knowledge Base, updates, technical training, then give Julie a call on 1800 800 232. Speak to you soon.